Welcome back, financial investors. My name is Brent, and today we're going to be answering a viewer subscriber question that was asked over on the Facebook groups, the FI Stock Market Investing, where we cover stocks, value investing, growth investing overall. And this individual had asked a question about Ford. Brent, what do you think about Ford in the short and long term? So that is what we're going to be taking a look at today. Ford earnings, we're going to look at them on the graphs. We're going to look at their balance sheets, how much debt they have, how many assets they have, earnings per share, return on invested capital. We'll go over quite a bit of it and show why I personally do not invest in Ford. And we'll also look at their dividend information here as well. So if you are brand new to the channel, have not yet subscribed, hit that subscribe button below. I cover the stock market, dividends, and real estate. If you're interested in any of those topics, hit that subscribe. If you do enjoy this video, find it helpful, hit the thumbs up. And if you have any comments, questions, drop them below or join our Facebook groups. We have the stock market investing, where we just talk about stock market overall. We have the dividend growth investing group, where we're only talking about dividend growth companies that show appreciation, that grow their dividend year after year. And we have the FI real estate investing, which focuses on asking questions pertaining to real estate, providing information, or all sorts of real estate. So I'm trying to build a community that is specific to what here YouTubers, viewers, subscribers would like to build on. So join the groups if you're interested in those, and let's dive into Ford. Now, there was a discussion earlier today where Ford popped up on a bunch of watch lists. There's investors that have been holding Ford since December. There's a lot of investors that have recently started buying into Ford. Now, I'm going to be taking a quick look, starting off with their earnings whisper, or an earnings whisper, kind of reading over what they just reported here recently. Now, this is showing here on June 2019 earnings. So maybe this isn't the most current one, but we'll go ahead and kind of cover this one and then move from here. So Ford reported second quarter June 2019 earnings of 32 cents per share on revenue of 38.9 billion. The consensus earnings estimate was 30 cents per share on revenue of 34.9. So they beat earnings, they beat revenue. The earnings whisper they were expecting was 37 cents per share. Revenue fell 0.2% versus the same quarter 1 year ago. Now, Ford, this is what caused them to kind of sell off either recently or in the past, probably right now. So they expect 2019 earnings right now of 120 to 135, where they were earlier expecting 137 per share. So they actually dropped their guidance, they dropped their estimates, and that caused Ford to sell off. Now, this information, this is showing negative 13.5%. Maybe this is over last year. Their consensus currently was 30 cents. They beat it at 32, so they did beat their current estimates. This is actually showing year-over-year growth of 18.5. Here's that year-over-year revenue growth of negative 0.2. So their revenue reported higher, up 11.3, and their revenue growth year-over-year was down 0.2%. So just a quick summary of their earnings. You could have paused it and taken a look more. There's not a lot more information down here. Now jumping over into the graphs here and taking a look here at their price. I'm going to be comparing Ford to General Electric, and I'll show you here why I am not an investor in Ford myself, but I can see why other investors would look at Ford and think it's a great value, or and such. I'm not going to tell investors not to buy anything or buy anything. I just provide what I am buying, why I'm buying it, why I would not buy specific stocks, and then leave it up to the investor to make the decision for themselves that whether they should buy it or not and continue to hold. Now, Ford here, 1 year period, we're at 956 right now. We can see 1 year ago, that is exactly where Ford was at. Now, we were in some tough times a year ago, and we fell with Ford all the way down to below $8 on January 24th, 2019. There was a double bounce right here, creating that W pattern, and then Ford shot up with the rest of the market. Now, if we look at the short-term 3-month here, Ford recently dropped from over $10 per share now to $9.56. If we bring in the 200-day and 50-day moving average here, and we go ahead and show this over the year period, we'll see that Ford just broke below the 50-day moving average, but it could continue falling even lower until it gets some support down in that 200-day point at 922. But if we look at it for the year, removing both the 200-day and 50-day, bringing in our yield, we can see that our average yield, if we go ahead, imagine a line right here in the center where the yield and the price crosses and creates an X. So if you carry this all the way right here, the price where the yield I would consider, an opportunity or so, would be around $8.80, $8.90. You would be getting a started yield right around 6.5%. And that would actually not have been even high. You can see back in December 2018, the starting yield was at over 7.5% with a share price of below $8 for Ford. Now, this could look like an exciting purchase right now at $9.56, but again, this stock can probably fall all the way until $8.80, where investors who are looking for some value then may consider buying into it. But I'm going to go ahead and continue showing you a little bit more. So now we're going to flip over to the revenue, net income, and free cash flow. Now, taking a look here at revenue, net income, and free cash flow, these are all three financials that I like to use when I'm looking into any company here. We can see that for the most part, they trend sideways with a little bit of appreciation there. I'm going to go ahead and bring in General Electric. Now, this is General Electric. We can see opposite lines here. Revenue going down, net income, free cash flow going down over a 10-year period. Now, if we go ahead and bring in our percentages here, we can see that Ford is still positive over the past 10 years, but if you break each of these up, divided by 10, you're going to see here that their revenue on average is 4.3%, their net income is 1.3%, and their free cash flow is up 0.8% on average per year. Now, General Electric, of course, they had some big warning signs 10 years over this period. Their revenue was down over the past 10 years. Their net income and free cash flow were down. So Ford's not like that right now. But could it be in the future? So we shall see how that kind of plays out. Now, getting rid of those, going back to our normal data, we're going to go ahead and take a look at free cash flow, the common share payout. Now, this wasn't a bad one. Their actual common stock payout is actually fairly small in comparison to their free cash flow. They pay out $75 million to their shareholders in common stock. They have a free cash flow of $7.41 billion. So that is if they had to cover it with free cash flow, they could probably cover it, or could be considered covered that way. Price to book and price to earnings and price to sales all brought in here. So price to book here at any 1.04. So basically you're getting a price. You're getting price to sales for one value there for the price to book. Book value is 1, and their price to sales down at a 0.24, and their current PE is at a 12.24. You can see here that their PE has been growing. Why? Their price hasn't been growing. Their price has been declining. It's their earnings that has been declining, and when you do the PE ratio, a growing price earnings ratio means that their earnings is going down and their price is basically staying stagnant. So we'll take a look at that here also in just a minute. Now, return on invested capital. Ford has a return on invested capital of 1.61%. Now, kind of comparing this to GE, GE obviously, this one fell off a brick at negative 10.08 currently. And what is another good value opportunity? I can't think of anything at the moment, but still, Ford, where has this been heading on a year-by-year basis? If you're looking at it, this is trailing 12 months in each period, each year. Where are their return heading? Right now, it is going down. We haven't seen any recovery on return on invested capital. If we brought in, Apple, for example, that's the only one I can think of right now, and take a look at their return on invested capital, it's declining. Their iPhone sales have obviously been dropping off a brick, but they're still showing a 24.83% return on invested capital. And I have a lot of stocks I mainly focus on that have an 8 to 10% or more return on invested capital. So look for either a growing return on invested capital or at least have a starting return on invested capital of a 10% or more. Now, we're going to look at assets and liabilities. Now, assets and liabilities here for Ford, we have almost a 1-for-1. So assets at $256 billion and liabilities $220 billion. Now, these numbers, everything here that I'm showing you are correct. I actually went over to the Yahoo Finance, went over to their financials, took a look here at their balance sheet, and took a look at their assets currently reported for 2018. So 2018, 540 billion. So basically $256 billion of assets. And here, their debt, we come down here, $224 474, 220, 574. So basically those numbers are all matching. So here we're basically getting a one-for-one value. So you're getting a $256 billion of assets, but you're also getting $220 billion of debt or liabilities. Now, kind of dropping down here, I want to go ahead and show you their earnings trailing 12 months. That's the one I kind of want to show you here. Over the past 10 years, again, we're looking at earnings on a year-by-year basis where, even though they're cynical, you can see they have really good periods where they make a profit. They have some profits here in the mid-year where a lot of them, March through August, I would say, summertime, springtime, they have a lot of big sales in these automotive industries. And you can see every year they have these big gaps where they make a lot of their sales. Well, overall, where is this graph going? Are their earnings growing or is it falling? Now, GE, this had a big comparison as well. We knew as of 2015 that General Electric was not bringing in earnings. There, it was on the decline year after year. They were losing. They had a bit of a spike here, 2016 and 2017, and just could not hold it. They just kind of continued to sell off. Now, Ford, again, earnings year over year, they have their big old cycle where they're nice and raising their earnings, but overall, they're guiding lower year after year after year. We can see earnings currently is in the orange and next year is in the blue. This current year is at $1.38 per share for their earnings estimate, but in next year they're guiding lower at $1.28 per share for their estimates here. So again, General Electric here, earnings currently, at least General Electric is trying to turn it around. So always look at where they're guiding into the future, what's projected into the future. If you look at let's see, normally, just kind of, I think this is estimates. It's estimated. They take the average that the company has been moving here, and then they kind of decrease it on average. Where does it go on average per year? Okay, they decrease by, 10% or so every year, so they kind of just estimated that. Now, operating income and their expenses. So how much income do they bring in and how much do they spend? Operating income, I guess we could bring it in for the 10-year here. And do we have percentages up? Yeah, we do. Or no, we don't. Okay. So operating income, they make $1.28 billion. And their capital expenditures is $1.63 billion. So do they bring in more income versus their expenditures, or do they spend more than they make? So here, expenditures are up on top, so they're not doing so well there at the moment. And we have long-term debt versus cash and equivalents. So here, in the blue, up at $154 billion is their long-term debt. Now, how much cash does this business have in cash and equivalents? Well, it has $16.72 billion in comparison to their debt load of $154 billion. So kind of interesting. So there's a lot of weight holding down this company. Their earnings isn't increasing. Their return on invested capital is not increasing. Their debt load is, ginormous. Their earnings are projecting and guiding lower year after year. They have just a ton of debt. They're not trying to, they're collecting more as of 2012. They've just been steadily increasing. Yes, the Fed's been coming out and raising rates. They're going to be cutting it, but that's not going to be helping them. Even if they cut rates here in the short term, they're eventually going to be raising them again in the future. And with all this debt load, that's going to work against them. Now, another reason I don't like this company is that as I invest in growth companies, I invest in dividend companies, I would call myself, I guess I primarily hold a lot of funds. I think my ratio is maybe 44% ETFs and funds and about 50 or so percent single stocks, somewhere within that range. Actually, I actually hold much more funds if I bring in my wife's portfolios, but I like to invest in some single stocks. It kind of brings it fun and entertainment. So dividend yield 6.28. They pay out 60 cents per year, and they pay out about 15 cents per not quarterly, 15 cents quarterly, 60 cents per year. That gives them a payout ratio of 43.5. Now, you would expect them to, with a payout ratio of 43.5, to be fairly reliable and safe, but they don't increase their dividend year after year. This is not considered a dividend growth investment. This company here, does not grow their dividend year after year. Instead, what they've done is they've cut their dividend. They had a crash in 2000. They started cutting their dividend. They couldn't sustain it. They were going into another recession. They cut it out completely. Now they started raising it again in early 2011. 2011, they started raising it, and in 2015, guess what? Remember what happened there? Their debt started climbing really fast, really hard here. Here's their 2015 period here. We can see just started climbing their debt, and I thought there was another area here. Maybe there's the liabilities. Their liabilities has been climbing here as well, but they couldn't sustain it. They could not raise their dividend because of their debt just increasing. It was becoming unbearable. So they've had some special payouts. I don't think they should be doing that. I think should be focused on paying down debt, figuring out what they need to be doing to get back in the business of growing their earnings, growing their return on invested capital, growing and declining their debt, increasing their income and such. But they have a lot of things to be fixing right now, and pretty much why I myself would not invest in this company. Now, I do hold, I hold quite a bit of companies, and if I were to compare, I'm not going to be doing a comparison to my companies at all, but there is just a bunch of signals that I look for, and if a company has any one of those signals, decreasing earnings, decreasing earnings per share, decreasing income, decreasing free cash flow, decreasing revenue, year over year, decreasing return on invested capital, taking on much more debt, expenses, blowing out their income. There's so many little red flags here within this company that I've kind of just shown you. That all makes me a lot of, wary, whether it's short term or long term. I don't think this company is sustainable at this point. I think they will continue to fall. Investors might gobble it back up below $8 as it becomes priced at that point. I think there's a lot of investors out there, and even institutional investors who it's an American company, and as investors said here, so I believe in the Ford brand with the potential of automation and commercial delivery, taking the big steps in the future with their restructuring to only increase their bottom line. I don't ever see it going out of business and growing stronger, and I don't think they're strong in their own niche. I've owned Tesla, I've owned Ford in the past, and Tesla is currently winning the world right now. A lot of investors are following it. It's taking over. They're pricing their vehicles low so that they can outbid and get more of their vehicles on the front line. So Tesla's moving towards profitability here, probably in the next 1 or 2 years or less. Once it happens, their price should move higher. Now, let's see here. Probably kind of going through here. I know there's a lot of talk. I know there's a couple others out here who are just, they want to see Ford continue to move higher. They don't see Ford going for bankruptcy or ever disappearing. They make quality cars, but just because a company makes a product that's of quality doesn't mean that it's profitable. I can come out here and make an amazing product and provide it for people, individuals. But if there's another shiny toy out there and that shiny plastic wrap on the side is a Tesla and everybody wants one, they don't want to be buying a Ford. I don't know, that's just my opinion. But we've gone over this video long enough. Let me know in the comment section below, what do you think of Ford? Do you think I have gone and maybe misrepresented Ford? Do you think it's going to show much more profitability here in the future? Let me know in the comment section below. I think there's a lot of red flags with this company based off the information that I covered here today. And I would just like to see other people's opinions. Of course, I am not an investor of Ford. I would not be buying Ford myself at this time. I don't plan on buying Ford here in the short term, So again, I am not a financial advisor, tax accountant. So if you have any questions pertaining to your investments, go out there, seek a financial advisor or planner and ask some questions pertaining to this. But here, I just kind of covered some of the facts, and let me know in the comment section what you thought. If you are brand new to the channel, have not yet subscribed, hit that subscribe button below. If you do enjoy this video, find it helpful, hit the thumbs up. And if you have any comments, questions, drop them in the comment section or join over on our Facebook groups. Again, those three are the FI Stock Market Investing, FI Dividend Growth Investing, and the FI Real Estate Investing, all looking to build your financial independence. So thank you all for tuning in. I will see you next time. Have a great day. Bye.